All right, good morning, everybody. So I have the spot gamma levels already showing on the screen. We'll just start with those. S&P from the SPX and the ES is on the right, and then moving to the left, we have SPY, the Qs, and then the NQ and the NDX. Just take a screenshot. That way you can go back later on and put those levels into place for the day. When it comes to levels, by the way, I don't really get to hit it very often because we have to wait for the email. But Tier 1 Alpha has a free email that you can sign up for, and it has levels on it for your major equity names. So it's got Apple and Amazon, but it also has the sectors, and then it has levels for the indexes like the Qs, the S&P, IWM. So oftentimes they'll overlap with these, but not always. And that means you might get a couple of new levels, but you also can reaffirm the levels that you see here. Right? Give it a little more context. And I just checked my email. They haven't come out with their email this morning, so can't go that direction. So today we have New York Fed President Williams speaking. If we come in and look at the anticipated economic events, we've already had the ones that passed, had some pretty high anticipated impact. But other than that, we do got the Red Book today. We've got two Fed speakers, Jefferson and Williams, additional auctions, and then Japan is going to release their data on foreign reserves. So reading the market update on Finance Juice, there was weak economic data coming out of China that messed with Europe, and now it's kind of bleeding over into the US markets. We're still set for CPI tomorrow, and that's going to have a really big impact on the market. Now, whether it has a big impact on the stock prices out there is a completely different discussion, but whatever this CPI number is tomorrow, it's going to change this wait and see that we're all in. So at the very least, we're hoping for, a dynamic shift in our point of view, which means we want to take everything that we're getting this morning with a little grain of salt and just kind of stick to our levels, because this shouldn't be enough to move us too far. All right, so we can see China here had that sell-off, took out 2 days of data. It's still inside of the May 2 candle. It was really big down move, and we still have our higher low. I'm pretty sure we had set a higher high. We did. So we have a higher high, and we have a higher low. So even with this drop down this morning, we still are on track for the moment, right? One of two things when it comes to Japan: either the Japan market had better news, or likely it closed before that negative news came out in China. Seeing that they had an inside day breakout and a really nice follow through, closing near the very high of their day. Right now over in Europe, inside day breakout fail, which, I mean, looking at it, it just barely got out of the top and now has broke below 50% of yesterday's level. So we are still inside day, but we're below the 50% mark. Kind of holds a little bit of weight. And looking at how we did with the dollar yesterday, that 101 level held from last week. We're starting to get the rebound or the rally out of it, but we are still IX10. It's not very exciting IX10 since we're inside of a really big candle. There's not a lot of anticipated exuberance or a compression here until we get out of this range. So we're still focused on 102 with the dollar and 101. Breaking below this low back here from April 14th would be a really big deal. Very likely see the S&P get above that 4,200 and stick the move. But getting above, say, 103 would very likely put us in a tailspin back down into the 39, 38 half area in the S&P. All right. So when it comes to the dollar, last year, it was like tick for tick. If it went up a tick, S&P was going down a tick. Now it's broader than that, right? We got to set these zones or these levels and kind of think about, all right, well, if the dollar gets above this, or if the dollar gets below this, then we'll anticipate the S&P getting above or below this level. Yeah, that's how it is. All right, additional auctions today are at 11 o'clock and 1 o'clock. I know it seems like I'm the only one that ever talks about these things, but to me, they hold a lot of weight. Even if we didn't have those, they still show up on a half hour and on an hourly time frame. And that kind of fits that narrative, right? Where I keep saying, watch the clock. I'm not being sneaky or slick when I say that. There's nothing deeper in the meaning when I say watch the clock. I'm serious, like watch the clock. If it's 3 minutes to a new hour and you're in a small account trying to trade with a tight stop, wait 3 minutes. You're going to get a surge of volume. It may not be a massive volume, but it very likely can be enough to wick you out of a tight trade. Wait 3 minutes. If we're near the low of the day or near the high of the day or near a pivot point, and you're trying to decide, hey, are we going to bounce off this pivot and go the other way? Or are we going to hit that pivot and break through it? Look at the clock. If it's near a half hour or near a new hour, prepare for the market to change whatever it was doing. Was it going up? Look for it to go down. Was it range bound? Look for it to break out. We had a very narrow IB through most of the night, and then we got into the kill zone. I can see that we're still on London time from yesterday. So let's get this back onto normal time. All right. So the kill zone, I didn't name it. I just know that it's there. It's between 2 and 4 in the morning. Statistically and historically speaking, this window in time has bigger moves than any other window in time in your entire trading day. Bigger moves than the open, bigger moves than the close. There is no other time in the day where you statistically get a bigger move in the market than in this 2-hour window. And it was proven here yet again this morning. Oftentimes when I come in, we will have made a move in one direction. I get into the office around 4:15 or so, 5 a.m. and I'll play the reversal back up, because depending on how fast we move down, it'll create a liquidity vacuum, and that just gives me a nice little bump back in the other direction. Get day done, and Bob's your uncle. But we didn't get the reversal back up. We got below the weekly pivot point, and that has kind of trapped us. I don't think it's the pivot point though. If you look, to the left, yesterday's low, when that news came out and the market did that quick dip, the options contracts across the marketplace didn't shake at all during that move. Like, it wasn't faked out even a little bit. So we're underneath yesterday's low. We have an inside day breakout to the downside if we're only looking at the RTH. And the volume again this morning is kind of light, sitting at around 74. If we didn't know why it was light, this would be a concerning number. We already know why it's light, so it's not a big deal. But if we didn't have anything on the agenda and we just came in and seen it sitting at 74, you would want to be concerned and start looking around, try to figure out why it's so low. We have Econ on deck. The market's really kind of in this wait and see holding pattern. So 74 is not a surprise. That's really the only thing we use this for, kind of gauging where we are at today in market participation. So once we've seen that, take it off and gain some chart real estate back. So when I zoom out, you can see this clear topping pattern. Friday going into the late afternoon, and then yesterday and now into today. It's a lower topping pattern than last week in the same time frame, right? There's Friday going into the close in the later part of the day, through Monday into Tuesday, and then down we went, right? But that was news, so don't forget that was that banking weakness, right? And then this was the FOMC. So we have a very similar week to what we had last week. The only thing is today, so far, knock on wood, we haven't had some really negative news come in that took the market down like it did last Tuesday yet. This was surprise news, not economic news, although there was economic news at the same time. So somebody could argue that it was economic news. I'm going to argue it was surprise news. It was that banking news, right? So when it's news that we can see coming, like an economic event, it's not really much of a surprise that we're getting the news, right? Whatever the data might be is surprise, has the capacity to surprise. But the fact that we have news coming at that time is not. So there's a difference between, oh, damn, didn't see that coming, and, oh, wow, those numbers were way different than what we thought it was going to be. Markets don't like surprise. It's usually where we catch them off sides and people get squeezed, and then they puke positions and we see really big moves. So we want to be looking for surprise today. We already know where the economic timeframes are. We want to be looking out for any surprise news. One source of that surprise news today could be these Fed speakers. All they got to do is say something stupid. All they got to do is inappropriately comment on something, talk out of turn, answer a question in a way that a reporter misinterprets. It's happened before, it'll happen again. So that's one location where we could get a surprise, is from one of these Fed speakers putting their foot in their mouth. Otherwise, the anticipation at the moment is that we're going to hold the line and wait for CPI. Now, the line to the upside is, I mean, it's as obvious as a sunrise. You can't miss it, right? It's the downside range that we don't quite have a grip on yet. I would start with that 4127, 4132 area. 4132 is a cog line, so that'll line us up really nice. It also puts us into this cluster from Friday where the market paused and digested, and a lot of traders took profits on that run before a new group stepped in and ran it up to the next level. So I like that zone as the low, that the boundary that we're going to use. Just keep in mind, whenever we have that range bound market anticipation, like we do and we did last week, you're going to want to expect to see a megaphone pattern. And it won't be just so pretty and clean and textbook perfect. But once you've got a range set, you'll start to see price kind of extend beyond the mean and then break beyond the edges. Each time it does that, it expands those edges just a little bit more until finally we get a catalyst and we break from one side or the other. So a megaphone pattern is what we anticipate. That makes sense, right? Now anything can break this. Last week on Tuesday, it was news that came out that broke it. And we had that big catalyst move to the downside, and it was all done and over with. At this point, we're still range bound, and we didn't wick outside. We didn't expand yesterday to the upside. We actually came up short. And we don't necessarily have a downside yet. We had that little dip yesterday, and that gave us a level, but we're already beyond that. So we could approach this from the point of view that we are right now wicking down below yesterday's level, and then we're going to come back inside the box. I'm not sure I believe that, because that's not much of a level. If there was unfinished business or trap traders or anything like that, they're done now, because we've been down here long enough for them to have more than finished their work. So it's not a catalyst location anymore. And price showed us that it no longer has any respect for it. So that level is no longer really even worth focusing on. So we got to think about the next level. 4132 being a cog line, and with all of this back here giving us a show of force, I guess is a good word for it, then that's a place we could look. I believe there's a voodoo line around that area, so we could certainly add those and see if it's got a tree line or a snow line or anything like that. No, 4140. It's a tree line. But that's it. We don't really have any voodoo lines in that area. Should have marked a cog line up there, but it didn't. I don't know. I don't fiddle with it. But that is a cog line, 41.32. And it's really the only thing we got until we get down to 41.11 when it comes to cog lines. The ADR right now is 1.9%. We don't have a market maker move. The ADR level is 41.25 and 41.75. Wow, that's cool. So 50 points, 25 to the downside, 25 to the upside. Beyond that, we have the full ADR at 4,200 on the upside and 4,100 on the downside. Notice the levels line up with, spot gamma, tier 1 alpha, these big major option levels. It's not a coincidence. Institutions and firms don't sit around staring at charts with tons of candles and indicators and all that, right? They're using line charts and watch lists with high, low, close in the watch list. Big key levels stand out to them that they keep track of because they're simple. I don't want to use the word lazy, but hey, it fits. They're simple. They don't want to get it complicated. All right, simple works. Simple makes money. 10-day, 30-minute volume profile with a TPO chart on the right in blue. We did interact with that point of control yesterday that we had talked about. It did perform as a magnet. We didn't make it through, and we've rejected again. We're at this volume shelf right now, and there's really nothing else down there. So they call that an air pocket of risk. If we break through this low that we currently have, there's really not much to stop us until we get down to the cog line around 41.11, 41.04, 41.06, right around in there. So it'd be a nice drop, right? It's a good 20-point move, and it should happen relatively quick, as we can see how price has moved quickly through those zones before, and it really didn't stop, slow down, leave a pivot point or anything like that. It's exactly what we're going to anticipate if we break through that zone again. We still don't have a classic shape, so a D, P, right? If you think about profiles and the shape that they're supposed to present in, we don't have one at the moment. If we do get a topside breakout and manage to get through Wednesday's high, which is a really odd high, other than the fact that it was, FOMC whiplash, there really is no reason for that to have been the high. Like, what did we hit? And I say that, but we had this one back here too. What did we hit? As a nerd, I'm always trying to answer that question. Funny enough, it might not have been the S&P that hit something. An inverse or even a correlated market could have hit something and, rejected the S&P. So if we can get through that, we do have a shallow zone there as well, and we could move relatively quickly into that 41.80 area. Now, I believe that there's a new cog line up here, but it hasn't been confirmed yet, so I'm not going to mark it yet. 41.80, it's either 41.86 or 41.88. It's a lot of work to validate a cog line, so it'll get done eventually. 5-day, 5-minute volume profile, kind of call this marking out your 5x5. If you hadn't noticed, I do have more than 5 days on here, mainly because when we grab those VPOCs, those volume points of control, I tend to widen the chart out a little bit to get older ones that I can just drag and put into place. So we have a VPOC from last Thursday. I think that was the day that I was gone. And it looks like we might have a VPOC from Friday unless we hit it already this morning. If we haven't hit it, it's really close. So I mean, it's like right there. So that was on the 5th. I'll just kind of adjust this. I'm going to leave it on there for right now. I know it really looks like it got hit to the tick, no less. But when it comes to these VPOCs or even just the POC, you can see how it's actually 3 ticks, 41.34 and a tick, 41.34 flat, 41.33 and 3 ticks. So I put it in the middle of those 3, but I mean, it's really a zone, right? As most pivots are, they're just not normally drawn as a zone. So we have that one. And then we have this new one down here from Thursday, from that day that I missed. Trust me, I'd have rather been here. Now, an argument could be made about this POC up here. Remember, I said that it's a zone. We wicked through that level, but we really haven't definitively closed through it with a solid push. So is there still work here? I would argue that it is still a level that you would want to pay attention to. I'm certainly going to be paying attention to that. 41.52.5. In an area 41.52 to 41.53, that whole little zone. If we come back up into that today, I'm absolutely going to be watching it. Now, if you didn't mark this VPOC, you would still be marking the same spot anyways, because it's the Globex high. So you can mark it because it's the VPOC, or you can mark it because it's the Globex high. Either way, 41.52, 41.53 is going to get a mark either way. So it doesn't matter how you got there. The cool thing is when your pivot points come from different sources. When you mark a level out because of one thing, and then you find that the same level should be marked because of something completely different, it has more confluence, right? Remember, we're not necessarily trying to mimic what everybody is doing, but we want to see what they see. We want to see what gives them thoughts, right? What informs their decision. So if 41.53 is an area that people watch who see pivot points, and it's an area that other people watch because they're looking at volume profiles, and then it's an area that other people watch because it's the high of the day so far, then we're seeing the same thing that multiple groups are seeing. And we didn't have to bring in extra tools or, bend over backwards to try to figure out what these other groups are looking at. I mentioned that megaphone pattern. This, of course, is a daily chart, and the pattern is a lot bigger. And we did come up short last week on the upside. We came up short on the downside. So that is a new high, and this is a new low, but it didn't go as low as I would have expected, and it didn't go as high as I would have expected. So it's a much narrower range than earlier anticipated. We are 0.5% above the 10-week, which means if we continue to move to the downside today, we're very likely going to hit it. We can come back to the chart, type in the word daily. You can get a daily SMA. I'm going to use an EMA, but whatever. Either one will do. Let's make it just a little bit bigger so it stands out in all this stuff that we have on the chart. So it's that big blue line. You can see how we are interacting with the 10 right now. Put that one on your chart. Because as you can see, it's going to be something that we are interacting with. So that's the daily, but we need the weekly. So we go in and do the same thing all over again. Only this one we change to the weekly. I want it to stand out a little bit from the other one. So just make it dots. It'll be big enough. We'll see it. There it is down here. So 41.14, really close to that 41.11 cog line. And 41.35 is the 10s. Yeah, your 10 week and your 10 day. Right now we're tangled up in the 10 day, but if we continue this move to the downside, we're going to hit that 10 week. And you really want to know when we hit that 10 week. You can see back here on Tuesday, when that bank news came out and the market dropped like a stone, it bounced on the 10 week. And it didn't stop perfectly because it's not supposed to stop perfectly. But it interacted there. It responded there. If we turned on volume profiles or a TPO chart or footprint chart, we would see that there was very likely an iceberg down here. And then the next time we went right through it. Right? We interacted with it a few times. Now we're back above it. So, let's kind of keep our eye on it. If you had done a top-down approach, you would have already known that there was a 10-week down there. There's some levels worth watching, right? The 200, 100, 50, 20, 10, 4. And then looking at them on your weekly, daily, hourly, 15. And oddly and crazy enough, you can use that indicator, that one that said daily, and you can put every one of those indicators on your hour or your 5-minute chart. But as you can imagine, it will be a ton of lines all over the place and it will be chaos, madness. So I don't recommend doing that necessarily. If you notice, some mornings when I come in, I don't have the morning briefing chart loaded. And I come into this list and I come down and I click that and I get my morning chart with all of my indicators. And it looks the same way when we start this briefing every day. Because no matter what I add to the chart while we talk, what I do to the chart through the day, tomorrow morning, I want to look at the same thing again, just as it was when we started this morning. Well, you could do that same thing with these indicators. Load the 10s and then, I don't know, save it. Load the 20s, save it. Do the 50s, save it. And then you could just jump through the charts. They're already made, they're already loaded. You don't have to spend the time rebuilding them every single day. You just got to go through the list. Putting together a morning routine might seem like a lot, but if you just break it down into little pieces and deal with one piece at a time and then put the whole package together, it's not that bad. All right, so bank stocks is what we're looking at here. KRE, those regional banks, they all basically have the same chart across the board. PNC looks a little better than the rest, but all in all, a dumpster fire still. XLK technology, since the NY Fang isn't open and we can't use the NY Fang until the open. Looking at these in aggregate like this kind of gets us to where we want to go. So Apple, Microsoft, Visa, NVIDIA, MasterCard, PayPal, Intel, and Adobe. I didn't choose these. If I was choosing tech stocks, I would pick something else. These are the top weighted names in the XLK. On Thinkorswim, you can go to the Analyze tab and go to Fundamentals and type in something like the XLK. And here you can see a list of the top names. I haven't looked at this list in a little while, so you can see that my list isn't accurate anymore. If I was going to get the top names by market weight, then I need to readjust with these new names. All right, so this is the top 8 names that make up the XLK in order of their market cap. Microsoft is leading, but it very often passes with Apple back and forth. They're so close, right, that they'll change back and forth. What we can see this morning is the semiconductors, or at least NVIDIA, is down a little bit. We really don't have any action out of ACN yet. Adobe, wow. No action out of that thing yet, but I would be looking for a change of this structure. That is a really clean structure. Cisco Systems sold off this morning, testing an inside day breakout early. We want to kind of put the pieces together. When we say what industry and what sector, it helps to break them down. All right, if we just say tech, that's too broad of a brush. Semiconductors, cloud, communications. Try to break it down into what kind of tech. Semis are really big when it comes to liquidity right now. When we think of liquidity tells, Tesla is one, and the other one is NVIDIA. So when we see NVIDIA moving around, we really want to pay attention to it and then follow that up with other semis and see what they're doing. So AMD, MU, TSM, SMH. SMH is normally my go-to, but it's broke, right? We had that situation. And until that gets resolved, I don't like this chart anymore. There are other semiconductor ETFs and ETNs that we could focus on. They just don't have the same liquidity, and I don't know. I don't like change, so I'm not going to swap off of TSM easily, or SMH, but I'll get there. Semiconductors do have a market maker move this morning, so they are worth paying attention to because they are getting bid in the front. Yeah, I can do that. Yeah, I'll show you. So someone asked if I was going to replace the semiconductors, how would I approach doing that? I'd go to Google because Google's your friend. And then just start out with your basic search. ProShares has a semiconductor. Then they have double and triple leveraged. I don't mess with those. It's just a personal decision. You do you. If you want to trade them, I don't care. It's your money, right? Do what you want. ETF Database is a company that I've gone to more than once. So you can see they have SMH at the top. SOXX, this one's really common, and I've looked at the liquidity before. I'm not against that one. But once we start getting into the double and triple leverage stuff, I'm just not a fan. I don't know the liquidity on all of these, right? And that's really going to be your main decision point. At least it's my main decision point. If I'm going to replace SMH with something, especially if it's something that I'm going to actually trade with, it needs to have liquidity. I'm not really a big fan of trading the shares. I'm more concerned about the options. So SOXX. No weeklies. That is not the one that I thought it was. It's pretty simple, right? As soon as I see no weeklies, we're done. Just like that, like done. There's no reason to even look any farther. Just move this list to the side so I can read it and type these in. And I could have searched on Thinkorswim too, by the way. I didn't have to actually go to Google, but not everybody's got Thinkorswim, right? There it is, SOXL. That's one of those triple leveraged ones, never mind. But that has liquidity. We can see it starts with the weeklies. $1 wide strikes and open interest in the thousands, even 38 days out. So I can't argue with the liquidity because it certainly has it. A decent liquidity too. Nice bid ask spread, 1 penny wide. If I was going to trade options, that's the kind of options I would want to trade right there. That's what I was looking for. SOXX. But it just doesn't have the liquidity that I want. So until I get something better, just going to have to hang out. If you were going to use your Thinkorswim, you can go to watch list and then come down to industry and go that route. find it. Right there. Taking that route, you could bring up a whole list, but that's going to be companies and so very likely I'll end up having to make my own, just like we make our own FANG ETF. It's not tradable, obviously, but we'll be able to use it for mapping out what's going on. All right, KWeb is down 3%. Semiconductors are down. Emerging markets, banks, really just about everything except bonds and Bitcoin and nat gas, a continuation in nat gas. Still a lot of work here for this before it ever comes back up off of these lows. But it's working on it, right? This is going to take a long time to heal this chart after all the damage that we've got here. Big gap up yesterday. The gap this morning is not showing, but we are up to 6.6 and we closed at 6.53. So it is up just a little bit, just trying to break out of yesterday's range. So we got an inside day breakout. But if you look at it on the weekly, we're behind this really big bar. So we got a lot of work here. Someone pointed out something yesterday when it comes to one of these really cheap stocks like UNG. And really, I was trying to bring up the other symbol, US natural gas spot price, XNG USD. Couldn't get it on Thinkorswim, likely because I'm not putting the backslash in the right spot. But here, this spot price is 235. Think about it from what's more likely question. What's more likely, that it loses 100% value or that it gains 100% value? Well, going to zero is very, very unlikely, right? So, okay, if we wouldn't go to zero, how about half price? Sure, that has the same amount of weight as getting 100% increase. So if we look at it from that point of view, there's a 50-50 chance that this could go down 50% or up 100%. That's a really good way of thinking about it. And we're talking statistics, right? Not candle patterns and momentum and trend or anything like that. We're not talking about any of that stuff. Just statistically, sitting where we are right now, what's the odds of losing half of its current value or doubling its value, going to 460 or going to 115, 120? Just use some round numbers. I'm in this. I've been in it for a long time, and I plan on being in it for a lot longer. So I'm comfortable where I am, but if you're trying to take a solid trade based on patterns and signals and a setup, you don't have one. This needs to give you something for a long entry, and it hasn't done that yet, right? So we need to at least set a higher high and a higher low. They say a trend is in place when you have 2 higher highs and 2 higher lows, or to the downside, 2 lower highs and 2 lower lows. As the set of 2 as a set gives you your confirmation of a trend. But at least getting one of each of those would be a good start. So one higher high and one higher low would be a good start. We don't have any of that yet. All right, Apple did break out of the top of that wedge yesterday. The fact that it went that deep into the wedge, I think we talked about it yesterday. It shouldn't have done that. So we want to kind of readjust the wedge. But, Apple is a name that continues to do things that it shouldn't have done, right? When it comes to like, wow, it really went really far and it kept going. Yeah, that's Apple. It tends to do that. So I wouldn't try to short this thing just because of how far it went. Tom tried that. It didn't work. All right. And that is like the smartest guy I could think of to name. He tried it and it didn't work. So if it comes to trading Apple, I would not short this until you have a signal to short it. At the very least, that would be getting underneath that yellow line that I have drawn, or at least getting below 5/5s low. All right, we get an inside day breakout below that level, then sure. I'm getting attacked by my cat. What's the matter with you, dude? Damn. I don't know if you guys can hear it, but there's a storm outside. Lightning and thunder. Freaking my cat out. All right, Google had a really nice expansion yesterday and it closed at the high of the day, or really close to the high of the day. We have a market maker move again this morning. We are looking at an ADR breakout on this. The ADR was 2.18. It's right where it was yesterday. If we go in and look at where we closed after hours, it continued to move around, but we are right back to where we closed yesterday. We closed at 107.77 and we're at 107.85. So we're like a hamster on a wheel. We're right back where we started. Keep your eye on Google. This might be a little bit of a last hurrah, right? That really looks like a blow off top. If it is a blow off top, we're very likely going to retrace that move. If it's not, then this all becomes a Busby and it's going to bounce there and make its way to the upside. So what you want to be looking for is a breakout above the Globex high and then a breakout above yesterday's after hours high for a continuation. But I'm a little sketchy on that continuation. Lots of resistance. Watch the round number. I'd look at 109 as my line in the sand. And other than that, guys, it's all about CPI, PPI. The expectation is still today the same as it was yesterday. We're going to hold the range in the S&P until we get our CPI data. So that's going to be our expectation, that we're going to stay inside of this really big box, this really big range from 5/5. And if you want levels, mark them on that 5/5 day. 50% is 41.20. 75% is 41.44. Right? That's not exactly 75, but it's close enough. Everybody be careful, be safe, have a good one. I'll see you all tomorrow.